Good day everyone. Today, my group and I will be presenting our interpretation of financial statements for the course Property Finance and Accounting. This analysis was prepared by Group 6. The focus of our presentation is a comparative financial analysis of two property development companies, which is Legacy Bina Group LBG and also Synergy Derby Property SDB. These two firms are selected as proxy companies to represent different segments within the Malaysian property development industry. So Legacy Bina Group acts as a proxy for mass market affordable housing developers, where the business strategy emphasizes cost efficiency, high operational agility, and faster project completion. This model generally prioritizes volume and liquidity management. In contrast, Synergy Derby Property serves as a proxy for premium and diversified developers, focusing on high-value integrated townships and strategic land banks. This approach typically involves higher capital investment but offers stronger long-term growth potential. The objective of this analysis is to evaluate the financial health, operational efficiency, and investment viability of both proxy companies. To achieve this, we analyze 8 key financial ratios covering liquidity, profitability, efficiency, and leverage. Through this ratio based on the comparison, we aim to identify the strengths, weaknesses, and risk profiles of each company. The findings will help us assess which proxy companies demonstrated stronger financial performance and sustainability. We will now proceed with the detailed analysis.
Liquidity analysis. For the liquidity analysis, we evaluate the company ability to meet in short-term obligation using current assets. First, the current ratio. Legacy Bina show a consistent improving trend, increasing from 1.35 to 1.6. This reflects effective working capital management and strong liquidity position, allowing it to surpass Synergy Derby by 2024. In contrast, Synergy Derby follow a declining trend, reaching 1.42, which indicates slow ground in current asset relative to liabilities and potential short-term liquidity pressure. Next, the quick ratio. Legacy Bina exceed the benchmark of 1.0, recording 1.05, which suggests the company has a liquidity cushion and can settle short-term debt without relying on inventory sales. Meanwhile, Synergy Derby quick ratio dropped to 0.79, indicating a heavy dependence on property sale to meet immediate financial obligation. Profitability analysis. Moving on the profitability analysis, this section evaluates the company ability to generate profit from its core operation and the effective use of shareholder equity. Starting with the gross profit margin, Legacy Bina achieved a peak margin of 33.85%, supported by standardized housing design and economy of scale in affordable housing project. This indicates strong cost control, efficient resource management, and effective pricing strategy. In comparison, Synergy Derby show a gradual improvement in its gross profit margin. However, it remains lower than Legacy Bina, suggesting weak cost management and lower operational efficiency. Finally, in terms of return of equity (ROE), Legacy Bina experienced a notable increase in 2024, reflecting its ability to utilize shareholder equity efficiently to generate high returns. On the other hand, Synergy Derby lower ROE indicate that the company is still in a gestation phase, where substantial capital reinvestment has yet to produce immediate profitability.
Now, let's look at efficiency analysis. This part is very important because it shows how fast this company can sell their product and manage their assets. First, for total asset turnover, Legacy Bina recorded 0.33 times, which is better than Synergy Derby at 0.26 times. This proves that Legacy Bina is more effective at converting assets into revenue. The focus on the affordable housing segment is the main reason, as the demand for this housing is very high right now. Next, for inventory days, Legacy Bina has a cycle of 775 days. Even though they are still faster than Synergy Derby, they experienced a sharp increase in 2024. This shows sales moment is slowing down. On the other hand, Synergy Derby at 824 days actually showed a steady improvement. They are successfully reduced the cycle from 904 days last year, which is a good sign for them. In summary, while Legacy Bina is more agile, the rising inventory for both companies shows that the property sector is facing a tough time due to high OPR rates. Legacy Bina needs to sell their stocks faster to keep their cash flow healthy. Next, let's move to gearing analysis.
Hi everyone, today let's compare the gearing analysis for Legacy Bina and Synergy Derby. Basically, we want to see how these companies manage their debt. First, the debt to equity ratio. Look at Legacy Bina. They are doing a great job. They dropped their ratio from 1.59 to 1.08. This means they are paying off debt and growing their own capital. Synergy Derby is on safer. Their debt is very low, so they don't have to worry too much when interest rates go up. Next is interest coverage. This shows if the company can afford to pay their bank interest. Legacy Bina is still in a safe zone at 3.94x. Even with higher bank rates or OPR highs, they are staying strong. But look at Synergy Derby. Their graph is shooting up. This shows they have plenty of profit to cover any loan costs, even if the market gets tough. Legacy Bina Group's help. First, liquidity. They are highly agile with a current ratio of 1.6. They have more than enough to cover short-term liabilities. Second, solvency. They have successfully cut debt to equity to 1.07, combined with a 33.8% gross margin. The company's cost control is excellent. Next, the main risk is inventory. At 774 days, their capital is tied up for too long. Improving this cycle is their top priority for efficiency. Solid foundation, but needs better cash flow. That's the report.
Finally, we have three main recommendations. First, Legacy Bina must monetize inventory. They need to aggressive sales to the 775-day inventory trap and turn it into cash. Second, for debt reduction, the company should use their gains to lower the debt to equity ratio below 1.0 for better financial stability. And lastly, they should focus on ESG by investing in green technology. This is important maintain to their strong 3.8% profit margin in the future. That's all for our presentation. Thank you for watching.